Hey guys, this is Esteban, your mortgage mate, and making this video today to talk about a really great loan program known as the FHA 203B program, or the FHA program for resale ready homes. And what I wanted to talk about is really, what is the FHA? What are some of the advantages and disadvantages of using this loan program? Who the program's really for, and what the end game is, after you get your FHA loan. So what is the FHA? The FHA is the Federal Housing Administration, and this is a government agency that provides mortgage insurance for mortgages made by FHA approved lenders. And so what does that mean, right? What happens? And so if you as a borrower default on your mortgage, if you stop paying, the lender can make a claim to the FHA for the unpaid principal balance, and they'll pay it. So really what's happening is the government is backing you as a borrower and insuring you. So this allows lenders to take on more risk, right? They can take on borrowers with lower credit scores and lower down payments. And so going on to the advantages, a big advantage oftentimes is the mortgage insurance and how it's calculated. Mortgage insurance is calculated based on loan to value versus your actual credit score. So that mortgage insurance, that fee you pay if you put down less than 20%, it can oftentimes come out to be less with an FHA loan, right? This depends on your credit score, but for first-time homeowners that haven't had a lot of time, first-time buyers that haven't had a lot of time to build credit, it's a great program for them because it keeps their mortgage insurance low. It also comes with low interest rates, right? Because the government's backing you. You get a really competitive interest rate. You also have the option of doing some really low money down, right? You can go down to 3.5% in the down payment of this program. Another piece is a low credit score. The FHA will allow you to go all the way down to a 500 credit score with 10% down. Beyond that, you're looking at 580 credit score if your down payment is less than 10%. So yeah, 580 is pretty great. Most cases conventional, you're at 620. You have to be at a 620 credit score to qualify. The FHA also allows higher debt to income, so you can qualify for more property or a higher loan amount with an FHA loan. Another cool piece is the seller assistance. You can get up to 6% seller assistance on an FHA loan. Put in the minimum down of 3.5%. So what are some of the disadvantages with this program? Well, mortgage insurance can be an advantage, but it also is a disadvantage. And the reason why is if you put less than 10% down on your loan, you're going to be carrying mortgage insurance for the life of the loan, right? Or 30 years. If you put less than that 10% down, you're going to pay mortgage insurance for a very long time. Another disadvantage is the property limitations. Most condos won't qualify for an FHA loan, and the reason why is the HOA actually has to apply with the FHA to accept FHA financing. And there's a few different reasons why, but most HOAs don't actually apply for the financing because they haven't had trouble selling. Owners don't have a lot of trouble selling condos as with the market as it is with two conventional buyers. So for now, condos don't, most of them won't be able to accept FHA financing. Another property type that doesn't work for this program is a distressed property. If the FHA wants the house to be in good condition in order to fund that loan. So a house that needs a lot of work that generally isn't going to qualify for this 203B program. Another type of property is a resale, a resale that's under 90 days. So if a homeowner has owned a property for less than 90 days, most of the time it's a flipper. If they're trying to sell that house, the FHA won't fund that loan if the previous owner hasn't had it for 90 days or more. So yeah, that's a limitation there. Another limitation piece is the appraisal. The property, as I mentioned before, it has to be at a certain condition in order to get the funding. And this comes about in the appraisal, right? When the appraiser goes out, they do their inspection and they point out things that have to be repaired that the FHA requires. So some items that come up pretty frequently are, chipped paint is not acceptable, or a broken window, bars on windows, different elements of that nature. Sometimes they're more drastic, right? You really want them repaired, but sometimes they're minor. And so what this does is that this puts more red tape around your offer. So depending on what the market looks like, right? Is it a seller's market or a buyer's market? If it's a seller's market, if you got 10, if a seller has 10 offers, 7 of them are conventional, 3 are FHA, the likelihood of the house, if all the offers are the same, the likelihood of the FHA offer being accepted is much lower, just because of that red tape piece. Sellers don't want more work or more money out of their pocket. Another big disadvantage is the upfront mortgage insurance premium. When you get an FHA loan, it comes with a 1.75 added cost of the total loan amount. So that's a pretty hefty fee, right? If we're looking at a $300,000 loan, FHA, right? They allow you to finance that 1.75%, but really what that does is that increases your loan amount. So if you were borrowing $300K and then you're doing an FHA loan and you finance that fee, now you're borrowing $305,000 and some change on your loan. A lot of times people don't even know that they're financing that fee into their loan. I've had individuals call me after they get an estimate, or they're getting their docs, and they say, "Hey, Esteban, I'm doing this loan and I don't understand. I'm putting 3.5% down, but when I do the math, my loan amount's bigger, right?" And that's because the lender's rolling in that fee, right? And what does this mean? Well, it means you just pay more money in interest over time. So that's a disadvantage to doing that program. But really, who is the program for? The program is for first-time buyers. The FHA allows a low down payment, right? 3.5% down, and low credit scores all the way down to 500 with 10% down. This is also a really great program for credit rebuilders. The FHA allows a history of bankruptcy and other derogatory credit events. 2 years after a Chapter 7, you can get your FHA mortgage, or 1 year after a Chapter 13. They allow unpaid charge-offs on your credit report, so really helps those people get back into a home. And new investors is another great group, right? It's pretty cool. The FHA allows you to do the minimum 3.5% down up to 4 units. So you can actually get a fourplex with only 3.5% down. Whereas in most cases, most lenders will require 15% for a multifamily property. There you can find some that do 5, pretty rare, but in most cases it's 15. So 3.5 is a big difference. And this allows a new investor to start accumulating those doors and building a portfolio faster. Now, what's the end game with your FHA loan? Well, really you want to get out of that as soon as possible, 6 months or 3 years, as soon as the market permits. You want to get out of the FHA loan, and the reason why is that mortgage insurance element. It's on, in most cases, people are putting less than 10% down, so it's on there for the life of the loan. And to kind of elaborate on that, I have the FHA mortgage insurance premium matrix right here. Most people fall into this category, over 95% loan to value. So they'll pay 85 basis points, right? So if you're putting 3.5% down, you're looking at 96.5% loan to value. And most cases higher, right? If you're financing that 1.75% fee, you're over that 96.5% on your loan to value. So you want to get rid of this fee. And if I break it down here, say you're purchasing, say for example, purchasing a home at $300,000, you put the 3.5% down, which leaves you with a $289,500 loan amount, right? That $289,500 times the 85 basis points, just under 1%, leaves you with just under $2,500 a year paid in mortgage insurance. If you calculate that monthly, that's $205 a month just going to mortgage insurance. And so you really want to drop that off as soon as possible. And to further illustrate here, if you were to refinance your FHA loan to a conventional loan, and all the terms the same except for no mortgage insurance, right? Same interest rate, same property type. If you were to do that, if you were to add that $205 savings to your monthly payment, if you were to continue paying the same amount you were paying before in your FHA on your new conventional, you would pay your loan off a lot sooner with that extra money. So, 23, you'd pay it off in 23 years with an extra $205 payment. Of course, if you already had the home for a year or so, you're still shaving off 6, 5, 4, several years of your mortgage with those savings. So you can see you want to get rid of that as soon as possible, either to get more change in your pocket or pay your loan off sooner. So I hope this was really helpful in learning about the FHA program and what the strategy is with it. If you have any questions, please reach out. I appreciate you watching this video.